financial analysis, common analysis, and comparative analysis. The financial statement analysis refers to the classification, diagnosis, and comparison of data of financial statements so that the profitability, financial position, managerial efficiency, and weakness of the business may be disclosed. This lesson discusses dynamics related with financial statement analysis. It follows from the previous slide that after studying this lesson, you would be able to understand the meaning of analysis and interpretation of financial statements. Know the procedure for analysis and interpretation of financial statements. Describe the type of analysis of financial statements. Analyze different techniques of analysis and interpretation. Before the analysis, the objective and extent of analysis and interpretation should be determined. All the required financial data should be collected and studied from financial statements. To reduce the complexity of financial statements, the figures of the financial statements should be approximatized to the thousand or hundred. To create a relationship among the income statement and financial position statement, different analysis techniques as ratio analysis, trend, and common size should be used. If there are given some additional information relating to interpretation except financial statement, those must also be collected. If it is required for the comparison, the financial data should be rearranged in the tables in a logical way. To interpret the financial data and to draw a conclusion, the proper tool is average comparative statement. The figure here shows various types of financial analysis. Internal analysis of financial statements is done by such person who can access the book of accounts and other related information of the business. External analysis of financial statement is done by such parties who can approach the books of accounts as investors, creditors, and general public. This analysis is based on the published financial statement. They cannot access to the enterprise for data. Horizontal analysis is also known as dynamic analysis or trend analysis. When the financial data of a company for several years are analyzed and compared, such type of analysis is called horizontal analysis. For this type of analysis, the data of different years are kept in different columns horizontally. Vertical analysis is also known as structural analysis or static analysis. Under this type of analysis, a single set of financial statements prepared on a particular date is analyzed. In this analysis, only the quantitative relationship is created or one item of the financial statement is compared with other items of that statement as percentage of assets to total assets and percentage of ratio to profit. Comparative financial statement analysis is very important for the analysis and interpretation of inter-firm financial statements and can be prepared for comparison of results and financial position of two firms. Similarly, the interperiod financial statement can be prepared interperiod, and comparison is done very easily to interperiod financial statements. For the preparation of interperiod comparison, the accounting data of different periods are shown in different columns along with the absolute and relative changes. Relative changes are calculated in a percentage based on the previous year. The comparative financial statements are only concerned with the changes, but they do not show the relationship of the different items of balance sheet with total assets or total liabilities. In the common size statement, the relation of the individual items of the balance sheet to the total assets is shown in form of the percentage. In the case of common size balance sheet, in asset side, the total of assets is treated as a common base. On the basis of it, the percentage of other assets are calculated. Trend analysis is an important technique of the analysis and interpretation of financial statements. Generally, the trend means tendency. To know the tendency of the data of the financial statement, the data of 4 or 5 years are required. Data may be taken from the balance sheet and profit and loss account. It depends on the objective of analysis. To compute the tendency, 1 year's figure are taken as base year. On the basis of the base year, the other year's relative figures are computed. On the basis of these relative figures, the tendency of a particular item is determined. Fund flow statement does not reveal the financial position of the business, like the financial statement, but it reveals the changes in various working capital in 2 periods. Working capital is the lifeblood of the business. The statement also gives information regarding the sources and application of fund. Cash flow analysis is also similar to fund flow analysis. Now it is being prepared by companies along with balance sheet and profit and loss account. It is prepared as per the Accounting Standard 3 of the Institute of Chartered Accountants of India. The fund flow statement reveals the changes in the fund working capital, while the cash flow statement reveals the changes in the cash during 2 periods. It also gives the information regarding the source of cash and uses of cash during a period. Ratio analysis helps the management and different users of financial statements in determining the profitability of business and financial position of the business. Profitability, solvency, liquidity, and efficiency of the business can be easily determined by this analysis. Under break-even analysis, the costs of production are divided into fixed and variable costs. From the sales of fixed costs is subtracted to find the contribution. On the basis of the contribution, the break-even point is determined. It is that point of sales or production at which company gains no profit and suffers no loss. Several managerial decisions as make or buy, shutdown point, price determination, etc. are taken with the help of. Let us understand the forwarding of comparative financial statements. To illustrate it through an example, we take balance sheet. To prepare the comparative balance sheet, the 4 columns are drawn. In the first 2 columns of amount, the absolute data of 2 balance sheets are shown. And in the third column, increase or decrease in the asset and liability as well as owner's equity are shown. And in the fourth and last column, the percentage of increase or decrease is shown. After preparing the comparative balance sheet, the analyst gives his interpretation regarding the financial position, both short-term and long-term, and profitability of the business. Comparative balance sheet may be understood easily in the example of Kavita Limited. The balance sheets of Kavita Limited for the year ending 31st December 2006 and 2007 are shown on the screen. If you have to show a comparative balance sheet showing increase and decrease, both in absolute figures and in percentage, and then interpret the changes, it will look like the next table. Please click. This table shows a part of comparative balance sheet. Due to the paucity of the space, it is not possible to show the full comparative balance sheet. But same as the way the identities are calculated and shown here, the rest of the identities are also in. Common size ratios are used to compare financial statements of different size companies or of the same company over different period. By expressing the items in proportion to some size-related measure, standardized financial statements can be created, revealing trends and providing insight into how the different companies compare. The common size ratio for each line in the financial statement is calculated as follows. Common size ratio is equal to item of interest upon reference of interest. For example, if the item of interest is inventory and it is referred to total assets, as it normally would be, the common size ratio would be common size ratio for inventory is equal to inventory upon total assets. The ratios are often expressed as percentage of reference amount. Common size statements usually are prepared for income statement and balance sheet, expressing information as below. Income statement items expressed as percentage of total revenue. Balance sheet items expressed as percentage of total assets. The example shown on the screen shows a common size income. Now let us look at the trend analysis. As already discussed, it calculates the percentage change for one account over a period of time of 2 years or more. Calculate the percentage change between 2 periods. Number 1. Calculate the amount of increase or decrease for the period by subtracting the earlier year from a later year. If the difference is negative, the change is a decrease. And if the difference is positive, it is an increase. Divide the change by the earlier year's balance. The result is percentage change. A similar trend analysis is depicted on the screen. Now let's check if we have understood the various concepts discussed in this lesson clearly. Under cash flow analysis, the costs of production are divided into fixed and flexible costs. Right or wrong? Please click. Wrong. The comparative financial statements do not show the relationship of the different items of balance sheet with the total assets or total liabilities. Right or wrong? Please click. Right. Fund flow statement does not reveal the financial position of the business. Right or wrong? Please click. Right. Before we end, let us briefly revise what we've studied till so far. Analysis of financial statement is the process of critically examining the data of financial accounts. The main work of this process is to find the strengths and weaknesses of the business analysis, and interpretation of financial statements are closely associated. Without interpretation, the analysis is useless, and without analysis, interpretation is impossible. Analysis of financial statement is of 2 types: analysis according to material used and analysis according to modus operandi. Analysis according to material used is of 2 types, that is internal analysis and external analysis. Similarly, the analysis according to modus operandi is also divided into 2, horizontal analysis and vertical analysis. For the interpretation and analysis of financial statements, the following techniques are used: comparative financial statement analysis, common size statement analysis, trend analysis, fund flow analysis, cash flow analysis, ratio analysis, break-even analysis.